Hello, and welcome back to Boni's Life, your go-to channel for navigating the exciting and often turbulent waters of the global financial markets. Today, we have a massive episode for you, one that could have a significant impact on your portfolio and the entire financial landscape. The day we've all been waiting for is almost here. Tomorrow, the Federal Reserve, the central bank of the United States, and arguably the most powerful financial institution in the world, will announce its decision on interest rates. The entire world, from Wall Street to Main Street, from seasoned investors to those just starting their financial journey, is holding its breath. Will they cut? Will they hold? And more importantly, what will it mean for your money, especially in the high-stakes, fast-paced world of cryptocurrency? We're going to do a deep dive into this monumental decision, a decision that will ripple through every corner of the global economy. We'll break down the probabilities, analyze the complex and often contradictory economic data, and look at what the sharpest minds in finance are saying. We'll even become financial historians for a day, traveling back in time to see what happened in similar situations and what crucial lessons we can learn from the past. And of course, we'll be talking about the elephant in the room, the immense and very public pressure from the Trump administration and what that means for the long-cherished independence of the Federal Reserve. But we're not just here to give you a dry news report. We're here to give you actionable insights to empower you with the knowledge you need to make informed decisions. We'll explore the different scenarios for the Fed's decision and what each one could mean for the crypto market, a market that never sleeps and is notoriously sensitive to these kinds of events. We'll even give you some potential trading setups, complete with entry points, targets, and stop losses to help you prepare for the market movements, no matter which way the pendulum swings. So grab your coffee, get comfortable, and let's get ready to unpack the most anticipated economic event of the year. This is one episode you absolutely can't afford to miss. Let's get into it. Before we dive deeper into the specifics of the US economy, it's crucial to understand that this decision isn't being made in a vacuum. The global economic landscape is a complex and interconnected system, and what happens in one part of the world can have a significant impact on another. We're seeing signs of a slowdown in major economies around the world. China, the world's second largest economy, is grappling with a real estate crisis and slowing growth. Europe is facing its own set of challenges, from the ongoing war in Ukraine to persistent inflation. And many emerging markets are struggling with high debt levels and the impact of a strong US dollar. This global slowdown is a major concern for the Federal Reserve. A weaker global economy means less demand for US exports, which can hurt American businesses and lead to job losses. It also increases the risk of a global recession, which would have serious consequences for the US economy. So, when the Fed is making its decision tomorrow, it's not just looking at the US job market and inflation, it's also looking at the health of the global economy and trying to anticipate the potential ripple effects of its actions. This adds another layer of complexity to an already difficult decision, and it's one of the reasons why this particular Fed meeting is being watched so closely by investors and policymakers around the world. All right, let's start with the big picture. What is the current state of the US economy? And why is the Fed even considering a rate cut right now? To truly understand the gravity of tomorrow's decision, we need to dissect the complex economic web the Federal Reserve is trying to navigate. It's a classic case of being caught between a rock and a hard place, a scenario where every potential solution presents its own set of problems. On one hand, we have a labor market that is flashing some serious warning signs. The latest reports from the Bureau of Labor Statistics are painting a concerning picture, one that suggests the engine of the American economy might be sputtering. In August, the economy added a mere 22,000 jobs. To put that in perspective, that's a significant and worrying slowdown from the 79,000 jobs added in July. And if we look back to June, the picture is even more bleak, with the economy actually losing 13,000 jobs. This isn't just a blip on the radar, it's a trend that suggests the robust growth we've become accustomed to is fading, and the Fed is paying very close attention. A healthy labor market is the bedrock of a strong economy, and when that foundation starts to crack, the entire structure is at risk. Now, on the other hand, we have inflation, and this is where things get tricky. The Fed's primary goal is to keep inflation at a stable 2%. For a while, it seemed like we were getting there. In April of this year, The Personal Consumption Expenditures Index, or PCE, which is the Fed's preferred inflation gauge, was at 2.2%. But since then, it's been creeping back up. In July, headline PCE rose to 2.6%, and core PCE, which strips out volatile food and energy prices, hit 2.9%. The more commonly known Consumer Price Index, or CPI, is even higher at 2.9% for August, with core CPI at a concerning 3.1%. So you see the dilemma. A weak job market suggests the Fed should cut rates to stimulate the economy and encourage hiring, but rising inflation suggests they should keep rates steady or even raise them to prevent the economy from overheating. This is the tightrope the Fed is walking right now. And to make matters even more complicated, we have the not-so-subtle influence of the Trump administration, which has been very publicly calling for rate cuts. We'll get more into that later. But for now, just know that the economic data is sending mixed signals, and that's why tomorrow's decision is so incredibly important. Now, to really understand what might happen tomorrow, we need to look back at history. How has the Federal Reserve reacted in similar situations in the past, and what can we learn from those decisions? History doesn't repeat itself, but it often rhymes. And in the world of finance, understanding the past is one of the best tools we have for navigating the future. Let's take a look at a few key examples that can shed some light on the current situation. First, let's go back to the 1970s, a period of high inflation and economic turmoil. This is a fascinating case study because it involves a president who was not shy about putting pressure on the Federal Reserve. I'm talking, of course, about Richard Nixon. We now have evidence from the Nixon tapes and the diaries of then Fed Chairman Arthur Burns that Nixon was actively pushing for expansionary monetary policies to boost his re-election chances. And what was the result? Well, many economists now believe that this political pressure was a major contributor to the runaway inflation of the 1970s. It's a stark reminder of what can happen when the Fed's independence is compromised. Now let's fast forward to the early 1990s. The US was in a recession, and the Fed, under Chairman Alan Greenspan, began a series of rate cuts to stimulate the economy. The unemployment rate had peaked at 7.8% in mid-1992, and by the time the Fed started cutting rates, it had fallen to around 5.5%. This was a more traditional response to a recession, and it helped lay the groundwork for the economic boom of the late 1990s. And of course, we can't talk about historical precedents without mentioning the 2008 financial crisis. This was a once-in-a-generation economic event, and the Fed's response was unprecedented. In the face of a complete meltdown of the financial system, the Fed, under Chairman Ben Bernanke, slashed interest rates to near zero. They also implemented a series of unconventional policies, like quantitative easing or QE, to pump liquidity into the system. This was a very different situation than what we're facing today, but it shows how far the Fed is willing to go in a crisis. So, what can we learn from all this? Well, a few things. First, political pressure on the Fed is not new, but it can have serious consequences. Second, the Fed's response to economic conditions is not always predictable. And third, the Fed has a wide range of tools at its disposal, and it's not afraid to use them. As we head into tomorrow's decision, it's important to keep these historical lessons in mind. They provide valuable context for understanding the potential outcomes and their impact on the markets. So, we've looked at the economic data and the historical precedents. Now, let's turn to the experts. What are the top minds in finance and economics saying about tomorrow's decision, and what are the markets pricing in? The wisdom of the crowd, especially when that crowd is made up of the world's most sophisticated investors, can be a powerful indicator. Let's take a look at what the professionals are thinking and what the market is telling us. The overwhelming consensus among economists and market analysts is that the Fed will cut rates by 25 basis points. According to the CME FedWatch tool, which is a widely followed indicator of market expectations, there's a staggering 96% probability of a quarter-point cut. The chances of a more aggressive 50 basis point cut are only at 4%, and the probability of no cut at all is practically zero. So, the market is very confident that a cut is coming. But just because a cut is expected doesn't mean everyone agrees it's the right move. In fact, there's a fascinating debate happening right now among economists. A recent CNBC Fed survey of 29 top money managers, investment strategists, and economists found that while 97% expect a quarter-point cut, only 41% think it's the right decision. 28% are actually in favor of a more aggressive half-point cut, and another 28% believe the Fed should hold rates steady. This division of opinion highlights the complexity of the current economic situation. Now, let's talk about the elephant in the room, the Trump administration's pressure campaign. President Trump has been very vocal in his criticism of the Fed and has repeatedly called for lower interest rates. The CNBC survey found that a whopping 82% of respondents believe that Trump's actions are designed to limit or eliminate the Fed's independence, and they are concerned about the consequences. 68% believe this pressure will lead to higher inflation, 57% see it resulting in higher unemployment, and 54% predict lower economic growth. We're also hearing from some of the biggest names in finance. Hugh Johnson of Hugh Johnson Economics says, the Trump administration is likely to continue its attempts to reduce the independence of the Fed, with an objective being to pressure the Fed to reduce short-term interest rates meaningfully and boost economic growth, even at the expense of placing some upward pressure on inflation. On the other hand, Thomas Simons, the chief U.S. economist at Jefferies, thinks the threat to Fed independence is overblown. He doesn't believe that Trump's appointees will have enough power to sway the consensus of the FOMC. So, as you can see, there's a wide range of opinions out there. The market is pricing in a 25 basis point cut, but there's a lot of debate about whether that's the right move and what the long-term consequences of the current political climate will be. This is the backdrop for tomorrow's decision, and it's what makes this particular Fed meeting so incredibly fascinating. Now, for the part you've all been waiting for, what does all of this mean for the crypto market? This is where the rubber meets the road for many of us. As you know, the crypto market, with its high-octane volatility and sensitivity to global liquidity, is a beast that reacts with incredible speed and force to macroeconomic events. And a Fed rate decision, that's the financial equivalent of a seismic event. So let's break down the potential scenarios, the probabilities, and most importantly, the actionable trading strategies that could help you navigate the turbulent waters ahead. We'll look at specific price levels, risk management techniques, and even how to play the altcoin market in each scenario. First, let's look at the historical data. In the past, Fed rate cuts have generally been bullish for Bitcoin and the broader crypto market. The 2019 rate cut cycle saw a slight increase in Bitcoin's price, and the massive stimulus measures in 2020, which included rate cuts, were a major catalyst for the historic bull run that followed. The reason for this is simple. When interest rates are low, it makes holding cash less attractive, and investors are more likely to seek out higher risk, higher reward assets like crypto. So, with that in mind, let's explore the different scenarios for tomorrow's decision. This is the most likely scenario, and it's already largely priced in by the market. So, what can we expect? Well, don't be surprised if we see a classic buy the rumor, sell the news event. In the immediate aftermath of the announcement, we could see a slight dip in prices as traders who have been front-running the decision take profits. However, in the medium term, a 25 basis point cut, especially if it's accompanied by dovish language from the Fed, is likely to be bullish for crypto. It signals that the Fed is willing to support the economy, and that's good for risk assets. Trading setup: look for a dip to the 110,000 to 112,000 support level for Bitcoin. Place a stop loss below the major support level of $107,000. Your first target should be the resistance level at $125,000 with an extended target of $135,000. Now, this is the wildcard scenario. A 50 basis point cut would be a major surprise to the market, and it would likely trigger a massive rally in crypto. This would be a clear signal that the Fed is very concerned about the economy and is willing to take aggressive action. In this scenario, we could see Bitcoin surge to the $130,000 to $140,000 range within weeks, and altcoins like Ethereum and Solana would likely see even bigger gains. Trading setup: this is a market buy situation. If a 50 basis point cut is announced, you'll want to get in quickly. Aim for $140,000 for Bitcoin, $4,500 for Ethereum, and $200 for Solana. Use tight stop losses as volatility will be extremely high. This is the black swan event. A decision to hold rates steady would be a major shock to the market and would likely trigger a sharp sell-off in all risk assets, including crypto. This would signal that the Fed is more concerned about inflation than the weakening job market, and it would be a very bearish signal for the economy. In this scenario, we could see Bitcoin retest the $95,000 to $100,000 support level. Trading setup: this is a time to be in cash or to consider short positions. Wait for the market to bottom out, likely in the $95,000 to $100,000 range for Bitcoin. It could take a few weeks for the market to recover from this kind of shock. So there you have it, 3 different scenarios, each with its own set of trading implications. Remember, these are just potential scenarios, and anything can happen in the market. It's crucial to do your own research and to have a solid risk management plan in place. But hopefully, this gives you a good framework for thinking about tomorrow's decision and how to position yourself for success. Let's delve even deeper into the crypto-specific ramifications. Beyond Bitcoin, the altcoin market is poised for a potentially explosive reaction. A dovish Fed sends a signal to the market that the risk-on appetite is back, and that's when we often see capital flow from Bitcoin into large-cap altcoins like Ethereum and Solana, and then cascade down into the more speculative mid and small-cap tokens. This is the altcoin season phenomenon that many of you are familiar with, and a Fed pivot could be the starting gun. For Ethereum, a break above its current resistance could see a rapid ascent towards the $4,800 mark, with some analysts even calling for a new all-time high before the end of the year. Solana, which has already shown incredible relative strength, could see a parabolic move towards the $250 to $300 range. However, it's crucial to remember that altcoins are a double-edged sword. While they offer the potential for higher returns, they also carry significantly more risk. If the Fed's decision is perceived as hawkish, or if the broader market sells off, altcoins will likely fall much harder than Bitcoin. That's why a tiered approach to risk management is so important. Your Bitcoin position should be your bedrock, your lower risk anchor in the volatile crypto seas. Your Ethereum and other large cap positions are your next tier of risk, and your small cap, more speculative plays should represent a much smaller portion of your portfolio, a portion you're willing to lose entirely. This way, you can participate in the potential upside of an altcoin rally without exposing yourself to catastrophic losses if the market turns against you. Remember, in the world of crypto, survival is the name of the game, and surviving to trade another day is the ultimate victory. So, what's the bottom line? After our deep dive into the economic data, the historical precedents, the expert opinions, and the political drama, what can we say with certainty about tomorrow's Fed decision? The truth is, not much. And that's what makes this moment so electrifying. We are at a crossroads, a pivotal moment where the Federal Reserve's next move will send shockwaves through the global financial system. The Fed is walking a tightrope, a high-wire act with no safety net, precariously balanced between a weakening job market that's crying out for stimulus and the specter of resurgent inflation that threatens to erode the purchasing power of every single one of us. And as if that wasn't enough, they're doing it all under the intense and unblinking glare of a political spotlight, with a level of pressure from the White House that we haven't seen in decades. The market, in its collective wisdom, has priced in a 25 basis point cut with near certainty. But as we've seen time and time again, the market can be wrong. And even if it's right, the real story won't be the cut itself, but the language that accompanies it. The Fed statement, the dot plot, and Jerome Powell's press conference will be dissected word by word, comma by comma, for any hint of what's to come. For the crypto market, this decision could be a major catalyst. A dovish Fed is generally good for crypto, while a hawkish Fed could lead to a sell-off. We've laid out the potential scenarios and trading setups, but remember, the most important thing is to be prepared. Have a plan, manage your risk, and don't let your emotions get the best of you. We'll be watching the announcement live tomorrow, and we'll have a follow-up video breaking down the market's reaction. So make sure you're subscribed to the channel and have your notifications turned on. You won't want to miss it. As always, thank you for joining me on Boni's Life. Stay safe, stay informed, and I'll see you in the next video.